What's up, everybody? We have another wonderful show today. Welcome to Best Bitcoin Data Show. I have my partners, Sminston with and Plan C today, and we have another wonderful set of content for you. We will talk about Bitcoin valuation models, Quantile Model. We will talk about updates to Sminston DK channel, and we will discuss Plan C's mother of all mega thread of the best Bitcoin analysts. He's been working on this for a long time, and we probably will get a peek into what he has planned for us. Okay, how are you guys doing?
Doing great, gentlemen. Good to be here with you. Good morning.
Awesome,
Yeah,
perfect.
doing well, guys. Great to be here again. I didn't sleep much last night, so I'm a little tired, but we're here nonetheless, and yeah, look forward to going over some more data as always.
Awesome. So, if you just joined us, if there nothing special happens, we always go live on Tuesdays at noon Eastern Time, 9 a.m. Pacific Time, and we aim to analyze the best of Bitcoin data. Sometimes it's our own models, sometimes it's interesting patterns that we find in the data out there. So we are also going live on several channels. So maybe our show is unique in that way. We are live on YouTube and also on several of our YouTube accounts, mine, Plan C, and Spinston, all streaming at the same time. So wherever you are, thanks for joining. Share your comments, and we'll read them on the show. But we already have 250 people joined. These typically go up to thousands. So very excited for our audience as well, and we can begin, I guess, discussing our first model. So what I'll do is I'll have a post that I did on Sunday, which is a sort of a culmination of all the work that Sminston and Plan C and I have been doing on the quantile model. And this is going to be unique because it gives us a specific playbook and strategy for the next year. Then we will switch to Sminston and Plan C. They each have one chart to present as well. And we'll take it from there. So without further ado, and because we want to really cap this one at 1 hour, I'll begin discussing my content. So let me share my screen.
I do want to point out while you're pulling that up, Sina, if you guys don't mind, I don't think it's a coincidence that since we started the Best Bitcoin Data Show, this is episode 5, we scratched 69,000 the other day, and today we dipped down just a little bit. But I don't think it's unreasonable to give ourselves a little bit of credit here. So I think we need to continue to grow the show and keep pushing that price up. So
absolutely,
just saying.
yep. Yeah, I'm sure the billionaires are watching our show and making purchase decisions. By the way, Bitcoin is just moving according to the model that we have, right? So it's, even though it has gone so much up, it's still hovering around the fair value that we've been able to calculate lately. And we introduced that fair value discussion, I think, a few weeks back, where the price was substantially below it. Now it has caught up. And if it follows the past trend and the assumptions in our models are correct, we are going much, much, much higher. So we still haven't even seen the main action yet. But with that, I will switch to this chart. Let's see what's the best way. Yeah, okay, so we are around that. Okay, this is a post I made on Sunday. It took me several hours work up until 3 a.m., but it was so exciting that I just couldn't sleep. What I was doing is I was creating a quantile model of Bitcoin, which again, Plan C, for example, has done amazing work on this, and we've been discussing this a lot on the show lately. But I was analyzing the specific quantiles to see if I can identify a pattern that explains Bitcoin's transition through different phases. Now, what I discovered, I tried several things, but what I discovered is that there are there seem to be three important quantiles that make a big difference in Bitcoin. So let me just show you something, and then I'll probably go back and explain the whole thing from scratch. But if you look at 33rd percentile and 66th percentile, and look at the chart here, you'll see that actually a lot of you can detect phase transitions between these percentiles. Below 33 seems to be the bear market bottoms typically, and black swan events, capturing a lot of the boring price action that has been happening in the prior cycle. Between 33 and 66, we have these kind of warm-up period where Bitcoin is getting ready for a significant explosion in the bull run, or maybe transitioning from the end of the bull run into the bear market. And then typically the top of the main price action of bull runs start after quantile 66. So it seems like, and even like if you notice, the top of the ETF bull run, ETF run coincided with 66 percentile. In the first crash in 2021 got us back down to 66 line, and a few times we had important reactions when we reached the 66 line. Again, another crash in the second cycle got us back to here. In the end of the first cycle, we also had reaction around that line. And same thing in the bear market time. There's a lot of reaction around this quantile 33. So it seems like these are important points for Bitcoin's phases. So based on that analysis, let's go back. So first of all, if you're wondering what is a quantile model, it's basically a regression model that uses the power law equation that models log of price as a function of logarithm of time, and time starts from the genesis block. And what we do is typically the traditional way to do this has been to run an OLS regression that models the average price, like a point that goes through the average of all the Bitcoin data over time. But here, the problem with that is not really a problem, but it only gives us the average, but it doesn't really inform us about the volatility around that average or the distribution of values around it. So there are many ways you can model this distribution. Perhaps you can run a much more advanced structural model that extracts distribution, maybe a Bayesian analysis or something like that. But a really nice way to strike a balance between simplicity and richness is to run a quantile model. A quantile model not only gives you it doesn't give you the average, but it gives you all the possible quantiles that you like. So it gives you the end of the distribution on both sides, the extremes, and then the median and anything else in between. So that way you can model the spread as well. So if Bitcoin is getting less volatile over time, this model will be able to capture that and give you nice bounds that match data a lot better than, say, for example, just getting an average and moving it up or down by some amount to get a bound. That kind of bound, in other words, the OLS model assumes that the volatility is the same over time, right? But quantile model does not. So it gives us a much more realistic view of the range of values. Now, if you run a quantile model, again, you get curves that match quantile. So for example, the Q1% that I've coded here, this is first quantile. This is a line that's designed such that only 1% of the data is below that, and 99% of the data points are above that, right? So that will coincide, if you extrapolate it to 2026, that will coincide 55,000. So it's only 1% chance that we will be below 55,000, right? And this is amazing because this gives us probabilities. Like it's not very sensible to determine and select a single value and say, okay, my price target is X, right? That's a lot better and smarter approach is to think in terms of probabilities. Everything is probable, but some values are more or less probable, right? So this model gives us something like that. Below 55,000, only 1% likely for the end of 2026. And then We can choose many other quantiles, and like I said, I thought maybe I can break the whole probability into 3 categories, 3 classes or bands. The next important quantile is 33rd, and that's $85,000, meaning there's 1/3 chance that we will be below 85K by the end of next year, and 2/3 chance that we will be higher than that. And then, this is kind of understating the potential, because you don't see how these quantiles, like 66 quantile, is way higher than 33 compared to the difference between 33 and 1. So to make that more clear, I can go to the second chart, and this is now a linear chart that shows us a little bit better, like the acceleration as we go up. So quantile 33 coincides with 85 at 2026, but the end of that band is quantile 66 with 136,000. So what this tells me is, if the distribution of probabilities follows our model, if that's correct, then you get a 2/3 chance that we will be below this number by the end of 2026, but 1/3 chance that we will be above that. How high it can go? It can go up to 285,000 when we look at 99th quantile. And this orange curve is designed again such that 99% of the Bitcoin data falls below it. So there's only 1% chance that it will be higher than this by the end of 2026. And we are not necessarily timing, right? We don't know when the actual peak will happen. It's very difficult to predict them. And if you even have a quantitative model for that, you're only basing it off of the last 4 cycles. So it can't be anything much stronger than a guess, right? We really don't have much cycle data to have a very reliable estimate of that. So at least in this analysis, I'm not trying to time the market. I'm simply saying, where are the valuation places? So Bitcoin can go to the top, by after the election, which is very unlikely, but it can top sometime in 2025, early or late. We don't know, but these regions allow us to figure out how far are we from the top, right? Or how overvalued or undervalued we are, and that was a basis for writing this analysis that gives us a kind of a playbook, right? So during the next year, and towards the end of the 2025, you're looking at these 3 bands as your guides. If you're anything below 85,000, we are in the first band, which I call the cold zone. This means the market is extremely cold and Bitcoin is very, very undervalued. So what you should do, not financial advice, but what the model says is you got to do aggressively accumulate. Bitcoin is very, very underpriced, and we're out of that range for now, right? We were actually in the blue zone for a long time. I was accumulating like all this process, and actually somewhere right after the end of the big crash, I was accumulating. In the blue I was, but I wish I did more. I still do, but not extremely aggressive now. So after we got out of the blue zone, we got into the green zone, which is, I call it, warm. The market is warming up, and you can actually feel that, right? The market, we are definitely out of the bear market depression and sadness, right? But we are now warming up. It really feels like we are kind of consolidating, and we're getting ready for an explosion. And actually, very recently, if you look at this downtrending channel, we seem to be wanting to get out of it with the recent price action. So the market is warming up, but it's far from even showing us the real potential of the bull market. Now, what do you do in that region? You continue to accumulate. That's at least my strategy. And I love to do dollar cost averaging. I call it DCA in, meaning you add using a DCA strategy every periodically add something. The simplest way to do that is to purchase equal amounts, and that has some nice properties that allows you to avoid worrying about all the volatility. Dollar cost averaging cancels out all the ups and downs and gives you exposure to the average growth, which is the fundamental fundamental valuation of Bitcoin. But if you want to use the maximum potential of this model, you can adjust your dollar cost averaging according to the risk. So you can also think of this as risk probability, as kind of a risk metric, right? If you're in the blue zone, the risk of going even further down is very low. So you got to be maximizing your dollar cost averaging if you follow that strategy. In the green zone, you get a little bit of more risk, but still the upside is much bigger. As we get into the red zone, and as these quantiles add up, the price goes up towards higher quantiles, risk builds up. So then the risk reward changes. It might still go significantly higher, but now the risk of crash also builds up. So you will adjust your DCA downward a little bit. And that's why I say in the hot zone, above 66 quantile, which will coincide 136 in the next year, $136,000 in the next year, you can do several things. First of all, if you are a permanent hodler, you can just continue what you're doing. If you're dollar cost averaging, continue that. Enjoy the ride. You will probably experience a significant crash, but you are diamond hand, so you don't care, right? Now, if you want to just add some more spice, like I said, you can make your DCA smarter and think about exiting, depending on whatever percent you're thinking about it, taking off the market progressively according to the risk. So let's say at quantile 66, 136, you still think this is too early. So maybe you wait until we reach 200,000. And then from there, you slowly trim your position. And the higher we go, you trim more aggressively. Because if we reach 285, according to this model, the upside is very limited. The downside is significant. So if you need money, if you need to buy something nice, that's the time to do that. But at the same time, it's never hurts to be a permanent hodler, and that works. That has worked perfectly in the past. And there's a lot of risk in trying to time these dynamics. But I think the smartest way to do that, if you want to, is to think in terms of probabilities and use a risk-informed dollar cost averaging method. Sorry for the long rant, but that's what I had.
No, that was great, Sina. That was well explained. And the thing is, I really like this, and I like the way you've divided up into three sections here, because I think it really, it simplifies things, but it makes a lot of sense, right? That lower third is, like you said, that accumulation period, and then you're moving up. It's interesting how you already kind of showed it on the last chart, but we basically got rejected right at the 66 line there. I mean, it just kind of was way too much too early. Like we were not ready. We had to consolidate for quite a while before moving up. But I guess one of my talking points we can discuss is this model, just so people understand, the way you've done this here is you're not you're not factoring in timing, right? So you're basically saying you're giving an even probability that we can peak at any point within the 4 years, and an even probability that we can be at the bottom at any point in the 4 years. So this is basically timing agnostic. So if we do kind of take if we factor in, say, the liquidity cycle, and we can do this with other models as we develop these other models that maybe can help with some of the timing. Most people would say, okay, this is the range, and we could technically be anywhere within that range. But based on historic patterns, we can say that we can assess potentially a higher probability that we're in the top third, second half of next year, maybe even into 2026. We don't know that for sure, but based on historic patterns, we can say we think there's a higher probability we will be in that upper range. So it's probably less likely that we're in the bottom two bands there, but we don't know for sure. So once we have liquidity models and other timing-based models, we can kind of dial it in more. But this just gives an overview. It's like it's saying, okay, this is the range. That's really the main thing here, and I really like that. And like you said, we can be anywhere in that range. We think we're going to be in the top of it, but we don't know for sure. That's really the summary for me.
Exactly, and this is, as you said, timing agnostic. So we are essentially we are admitting that predicting the exact point of top is very difficult. And like I said, even if you want to do it, you don't have a real strong statistical basis. You can come up with something, but going to be very difficult. Instead, what we will do is we will create valuation models that will inform us about the probability of being at the top, or probability of being overvalued when we get there. So at least when we get closer to the top, we'll have a way to assign a probability to it.
Sorry, one very last thing. So because just so people understand, so you're saying there's a 1% chance we'll be above 285K at the end of next year. There's a 1% chance, but that's only on that single day. like it's a 1% chance basically of being there like every day throughout the 4 years. So at some point you're going to reach it, right? But or at some point there's a decent probability of reaching it, but it's not like there's a 1% chance of reaching it throughout the 4 years. There's just a 1% chance of reaching it on any given day.
Exactly. So it's more like a Bitcoin will spend only 1% of its time above that value. But actually, if we follow the prior cycles, if we follow the prior pattern, we will get there, right?
We reached it the last 3 cycles. It doesn't mean this cycle will get there, but we have reached the last 3 cycles. So the probability is not 1% we reach it this cycle. It's, because people say, well, how can it be 1% if we reached it the last 3 cycles? But it's because you're looking at a 4-year window of time. So the probability is higher.
Yeah, it will be 1 day or 1 hour or 1 minute above that point, right? That's why the probability is low. But if you're worried about will we ever reach there, the model, again, with the big assumption that we will follow prior cycle patterns and we won't see a significant change in how Bitcoin works, then yes, we will get there. Now, a quick point on that: will Bitcoin significantly change behaving from there? Well, these models are cross-validated using a long period of time. There's a lot of out of sample data for a power law type growth. So we still haven't seen any significant deviation from this general trend, even with the major things that have happened to Bitcoin, including advent of the ETFs, or like crash after COVID. None of these really got us out of the bands that these models would predict. So if something really bigger than that happens, maybe, but we still don't have any evidence that Bitcoin will suddenly change trajectory moving forward.
Yeah, Sina. So a couple. So first of all, bang up job on these charts. I think you and Plan C both have this incredible talent for taking these very data-driven approaches and then putting together something that's very practically, very practical for the average person. And so a huge kudos to you for making this, and just the subtleties. I'm a sucker for the subtleties of beautiful visualization. Just the brightening of the area under the curve of the price data and things I'm just noticing now. So very attractive. What I love, a couple of things that I'm noticing. First of all, is just for the audience, as you go up in Quantile, each of those bands expand, right? I mean, you're breaking down each of these into thirds, but that upper band is the biggest band in terms of dollar range, right? So that's about 160K worth of a range. So as soon as you start to get into that band, the jump to the next quantile, it becomes larger and larger and larger, which is interesting. And so I guess what I'm getting at there is my mind is very visual, and I look at this in slices. I look at them in cross sections. And so the one that you've projected out to 2026, I like to think of this in my mind as like plotting this out itself as a probability distribution. If you were to take that cross section, right? So that vertical line from 99th quantile down to the first quantile, the way I think about this is, you have, what am I trying to say here? If you plot this in 2D as a plotted probability distribution, you can see how, or maybe even a cumulative probability distribution, right? Because we're talking about probabilities here.
Mm-hmm.
You can see as you're going up the curve, if you imagine like the CDF, the higher and higher you go, the further you go to the right, then smaller and smaller that slope is as you go to the right. So that shows you, basically your highest potential for returns are up but no further than the top of that green band. So I really like this. This has a lot of potential to guide people as we move through the next year or two. And it's purely driven by what's happened historically. So this is all deterministic probability, correct, Sina? So this is, this opens up the door to so many possibilities of potential price prediction. Again, I like the timing of the cycle agnosticism. I'm of the same mind with that, although, there's probably a lot of literature, a lot of studies to show that there's some timing that's correlation to liquidity cycles and elections and these different preconditions. But I think at the end of the day, I think we're similarly minded where Bitcoin can do unexpected things from cycle to cycle. So this gives a good overall view probabilistically, and I really love it. So nice work.
And we want to be really honest from the analysis. Like last cycle I was talking to a lot of people that were like, I look at what Plan B thinks, and I plan my life around that price happening. But I always try to kind of warn people about these things and try to teach them that you have to have a probabilistic mindset. Everything is possible. But you can just say that some values are less likely, some values are more likely, right? But everything is possible. You shouldn't, plan in such a way that certain actions will wipe you out, right? So you got to be very careful understanding and interpreting models like this. So it gives you a guide, but you need to be prepared for everything.
Yeah, exactly.
One more thing. I'm just sorry to harp on this, but I love, again, imagining that 2026 slice. If you extrapolate those probabilities, if you extrapolate all the way to the 99.9th, 99.99, 99.999, and you keep doing that right on a probability curve, you can kind of like look at the intersection of what the price would be versus the 99 point, it basically 10 to the -5th or -6th, -7th likelihood that the price will be there, and you will see a very, very high price, but your chances of hitting those numbers are going to be so minuscule, right? When you start getting into the 500,000, 600,000. I think it's really interesting.
Yeah, exactly. I mean, there's a probability of getting to $1 million, but that probability is so small that it's not even worth discussing, right? Like there is a theoretical probability that Bitcoin gets to $1 million this cycle, but is it the most probable outcome? It's not. It's it's extremely low. So, yeah, we got to look at what's the highest chance of occurring, I guess the one last thing I was going to say is we can also, there are ways to kind of assess the potential of how far we think we can move up in these quantiles throughout the cycle. Like we can assess liquidity compared to previous cycles and kind of get a relative, okay, how much liquidity do we have relative to previous cycles compared to how high we got. We can look at the flows through various ways. We can look at the flows of money coming into and derivatives. We can assess a lot of things to kind of get a kind of a potential of how far we think we'll go. It's not just going to be, kind of a random guess. We'll try to do our best to look at as many other metrics as possible to assess like kind of the potential and the fuel we have to kind of go higher up on this quantile band. But this is a great starting point.
Yeah, and a few people were asking about the super highly dangerous zones, and that's where I added the 90th quantile, 211,000. This is where you see like the top of the peaks will happen. I would be like, my personal thinking here is whenever we get to this band, this newly colored red band, above 90th percentile, I would be ready for a massive crash at any point. I mean, you might go up. As you can see, there is a whole lot of range here, $1,000 of range, but the risk reward has now changed at that point. So I would really call this one 90th percentile really the danger zone. And as you can see, we can go all the way up. And as you said, who knows? Maybe we go all the way up to 1 million. But at that point, we are going to be so overvalued and so volatile that, first of all, that may only last for 1 second. And if you think you can get out at the $1 million point, you're seriously overestimating your power in the market. so in some ways, I don't even worry about the top because I'm not gonna be able to exit at the top, right? Just have to be honest with ourselves, and it's much better to, again, to think in terms of risk. So if you need some money and if you want to take some profits, you got to do it slowly, step by step, based on an understanding of the risk reward. So in some ways, I'm actually a lot more interested in the bottom growing than the top, because top isn't for me, right? I'm not
Right.
gonna
Yes. That's
try
a good
too
point.
much, play with that.
I'm with you there, and I think I think fundamentally, going back to the fundamentals of the power law, right? I always come back. The closer you get to the tops, the more speculative you become, right? We just need a lot more data. This is probably the best way to aggregate that data to make some kind of a band projection. But I agree. I think monitoring this continued growth and seeing it stabilize and improve, as a function of Bitcoin's network growth and adoption, is really interesting to me. So I always come back to that, and I want to keep a close eye on that, especially as we go into these brave new times.
Absolutely. A
Yeah.
lot of interesting things are cooking under the surface. I love boring periods in the market because that's not stopping the development, that's not stopping the adoption. It's only keeping price from appreciating, because that gives us more time to accumulate. But then at any point, I'm just excited about all the beautiful things we will learn about in the next phases of the market. So be sure that big people are accumulating. ETFs were just killing it this last week. They've been accumulating a lot. There's a lot of discussions under the surface. The institutions are piling in. MicroStrategy style is multiplying right now. And everything is as bullish as it can be.
There's a lot
So
of big headlines, like you're seeing every day on X. We're seeing different headlines about so and so companies, bought 100 million Bitcoin or whatever. Like there's a lot of big accumulation going on, right? Still, so interesting thing though, just so people can kind of keep this in mind, it wouldn't be abnormal for us to actually go sideways until next year. Like it's actually happened in previous cycles. If you go back and look at the patterns in previous cycles, we actually didn't really get above the 50th quantile, like the fair value, like we looked at previous weeks. We actually didn't really get above that in 2 out of the last 3 cycles until next year, technically. So in 2017, that cycle, we actually, I believe, we didn't break the 50th quantile until early 2017, and same with 2013. So it wouldn't be out of the question, or wouldn't be like abnormal for us to actually just kind of hang out and go sideways until even like February. I mean, it's not out of the realm of possibility. Now, I don't necessarily think that's going to happen, but it's not, it's a scenario to consider. I mean, we've already been going sideways for 8 months, so I think it's a low chance, but it's possible.
exactly.
Yeah, I mean, there was a 4-year winter, right, between 13 and late 17. So
yeah, well, I mean, it's just like, as far as the bull run starting, like people forget how fast, like the full bull run, I mean, like the parabolic part of the bull run. So in 2013 and 2017, we actually, like those cycles, if you go back and look at them, things got overheated very, very quickly. So it would be the equivalent of us kind of going sideways until February or March of next year, and then shooting up and peaking at the end of the year, like really quickly, right? So that's kind of, that's what's happened in the past. But we'll see. I mean, last cycle we started to kind of rally more this time of the year, right? Like if we look at what happened in 2021, it was actually around here that we started to kind of really move. So we'll see.
Perfect. All right. So I don't want to monopolize the discussion. We still have 2 more charts from you guys to discuss. So what do you think? What do you say we move on to? Which one is it?
Svensson's, go to his first.
Yeah, we can hit on mine. Yeah, to be clear, Sina, this is a hit this past week. So a lot of value added to the space with those charts. So I really appreciate it.
Thank you, guys. Go ahead. What are we looking at? What is this telling us?
Okay, so a lot of people who've been following my account have noticed that I'm an experimentalist. I'm seeing what we can do with interesting angles to that we can, and analyses that we can apply to the data. Fundamentally, I'm most interested, like you said, Sina, in the power law support and the fair value trend and the strengthening of that power law function. Secondarily, I'm quite interested in trying to see how we can put bounds around what the very tops of these bubbles might do. And so I guess just disclaimer here, absolutely not financial advice at all. And I would still put this in the, I think this is very interesting. It's one of the most interesting models in my book, which is why I spend so much time on it. But it is, I'd still probably put it in the marginally to moderately speculative. Maybe I'm even being a little too liberal there. But I wanted to make a post on the decay channel oscillator and the decay channel model put together with some extrapolations of the model. And kind of my goals with this post are twofold. One is I wanted to put together a single figure that kind of relates the oscillator to the model in a little more of an intuitive way, so you can visually compare the two and see how we're getting to the oscillator from the model. I realized I hadn't been doing a great job of that, so hopefully this helps some of the followers. And then secondarily, I'm again modeling this upper bound based on that decay channel upper bound, right? The exponential decay of the cycle tops. That's what you're seeing there with the dashed lines. So those kind of the twofold goals with this chart. So firstly, I'll address the first point, which is these color mapped or these heat mapped line charts, right? If you look at the primary chart, that's the main one, you have linear scaling, right? So you have a linear time axis, the x-axis, and a linear price axis. And I've got all the historical data updated as of yesterday to the hour. This is all hourly data. And you can see as you get closer and closer to that upper bound, that's the decay channel upper bound, the more it transitions from dark green, which is the bottom, up to red. So it gets the most red when it touches that line, and then it starts to cool off, going through the orange, yellow, light green to dark green as it goes back towards the support. So just to recap on how I built this model is the support line, that's the thick, the solid white line at the bottom. That is, I'm just defining this. This is a little bit of a work in progress, but it's currently I'm using the 5th quantile support. So this generally accounts for a lot of the different winter periods of the power law when we're not going through a bull market. But it does allow occasionally for black swan events to dip through below that support line. You can see there with the Luna collapse and FTX collapse, end of 2022 there, happened right there. But generally, I mean, it's tracking the bottom of the trend. So that's the support. And then the way I build the upper bound of this model, the way I've been doing it is I take the very top residual, or the residual meaning the deviation, upward deviation from that quantile support model, and I take those exactly 4 points and I simply do a regression fit. Okay. And that's the way I've been doing it. And that's when you extrapolate that, then that's what you see go into the future. And it's the reason I keep using it is because it has an uncannily precise and accurate fit, those 4 points. And it is 4 data points. So the weakness of this model is the lack of richness, right? Or the lack of amounts of data at the top, which I acknowledge, I fully acknowledge. But the eerie part about it is that it's like it's nearly a 99.9% R squared with actually a low p-value as well. And so I've made a couple posts on that as well as an out of sample prediction, the way it's able to catch these. So it's able to catch the subsequent top extremely well, I guess is the point there. I'm not hanging my hat on it entirely. I'm totally comfortable with this breaking. At the end of the day, I don't see any reason why the very tops of these bubbles wouldn't be more unpredictable, to be honest. So it's a little thing, it's an exploratory thing, and it's something I'm tracking and trying to update. So back to my first point, you look at the linear chart, that's the big chart. Now relating that, this is the same price data translated and normalized into the oscillator chart. The oscillator chart is the small chart that I embedded inside of it in the upper left there. So now you can see when I make these updates, I'm essentially making that lower quantile bound, defining that as 0% in the oscillator. So that's the bottom floor. When we hit that value at any point in time, that's defined as 0%. So that over time will continue to crawl up because it's actually a power law. Does that make sense? And then if you look at the 100% value, 100% value is always defined as the upper bound of this decay channel model. So those dashed lines, think those dashed lines equals 100% in the oscillator, and those go up at a certain rate. And the support model in the big chart always equals 0%. So all it takes is a simple, numerical normalization to bounce, set one to 0%, set the other to 100%. And so those fluctuations in between that range is always going to be what's showing up in the oscillator from bottom to top. So I hope I did an okay job explaining that. But does that make sense to you guys?
Yeah, I think it was fantastic. I also noticed that you label this as a conservative model, and the top value that you're assigning to 2026 actually coincides very well with the 90th percentile quantile that I had previously. So pretty much aligned in there. Anything above 90th percentile in my chart sounds like above a conservative top estimate. So that makes sense.
This will be kind of
as you were presenting, I noticed the same thing. Yeah, I was making a note of it. Sorry, go ahead, Plan C.
I was going to say, like, it's interesting, right? Because so if we look at the model you have right now, we're kind of at least I am at this point. I'm giving probably a higher probability that we do peak in the second half of next year. So you could look at, roughly speaking, anywhere between, so if we peak, so what's kind of the range, I guess, if we peak second half of next year with this model? The upper part, is like if we peaked at the very end of next year and we go all the way to the top of the model, it'd be 207. And then if we peak kind of like at the bottom range of the model in the middle of next year, so say we peak because time makes a big difference, right? If we peak 6 months earlier,
yes,
we're getting kind of more in the range of what would that be? That'd be about 180.
Yeah, it's like roughly. You can look. I guess I didn't get to that part of the model, but in that little band that I formed in the upper right there, if you just look at the second, I'm just highlighting the year of 2025 there, assuming
right, because it could be any time. You're basically saying
exactly
any time next year. But if we
so that second half is like, call it roughly 180, 185 to like 207.
Yeah, so it's a pretty narrow range, right? That's the other thing. So we're basically the model's saying if it's second half of next year, it's between, like, say 180 and 210 at the far, even less, 185 you said to 207. Like it's not a huge range. And the interesting thing is, like, this will be the first model that will be tested, right? Like this will be the first one out of the two models we have, because the quantiles, at least as of now, we have to kind of still assess it. The other model is showing a little bit higher, but I mean, doesn't really matter. I mean, this will be the first one. We'll basically, some people will say, well, if you think this model is going to hold still, because we don't know, if it is going to hold, then this is a potential peak. Anywhere between, if it's second half of next year, it could be, because we've got to this peak, like you can see, like we've got a little over it or a little under it every time. So this pattern is held very solid. It's 4 data points, but they're like you said, they're it's almost like an absolute perfect fit. So it's hard to ignore something that's happened 4 times in a row and just think it's complete randomness. Now it could be, but it's still a little bit. There's something potentially going on there that we need to investigate further.
Yeah, it's a bit spooky. Yeah,
there's ways of potentially doing that. So the takeaway for me is that this is kind of on the lower end, but at the same time, it seems pretty reasonable, right? Like it's one. I don't think people would be that, like 180 to 210 is still a decent peak. Like, so that's kind of the first model to be tested. And then if we break through this model, I mean, we're all going to be happy because we all want the price to go higher. So we're not going to be upset about that. And then it's kind of like, okay, well then now we're kind of in the 90 quantile to 100. So then, where are we going to go from there? So it's just interesting how there is a difference between the models. It's not like massive, but there is a difference.
That's Thanks for adding that, Plancy, and I totally agree. I would say kind of one of the takeaways I get from this analysis is that, look, you can see this clearly. It's one of the reasons I like the linear space view. Sometimes, I know a lot of times us in the power law kind of analysis community, we look at log linear. Sometimes I like to look back at this because it's like, look, we've still, I think conservatively still have about 2.5 to 3x from where we're at today. And that looks pretty clear to me. And I guess the reason, a couple more points here, and then we can move on, because I didn't want to eat up a ton of time on this. But the reason I say that I feel that this is still conservative is that, number one, if you just think back to the quantile regression projections that Sina and also Plan C have been doing, there's still plenty of probability north of that kind of like 90th percentile sort of thing to go above this. We may or may not. And so that's kind of one reason that I think that this may be conservative. There's a couple other reasons I think that this may be conservative. One of them being that if you adjust, and I'm going to have some follow-up analyses on this model does make an assumption about where the it's called the asymptotic convergence of the exponential fit will converge to. This model actually makes the assumption it's going to converge over many, many years, over decades, into the support line. Not actually touch it, but it's going to approach it. It's going to infinitely sort of approach it without touching it. It does make that assumption. So there's actually, I want to make a couple, I'm still developing this out, right? If you adjust that quantile of convergence, it actually shifts those bounds, and it typically just shifts them upward. So I'm gonna show that in a future setting. So yeah, anyway, and then I guess the last point here is that linear versus nonlinear makes a slight difference here. But it doesn't make as big of a difference perhaps as where you tell the model to converge into the support line. So that's for an upcoming sort of analysis. So there's some sensitivities around this 4-point data fit that lend me to believe that there's plenty of room still to go north of this. I certainly hope that it goes north of this. So
just one last thing though that's interesting. So yeah, you're basically saying there's a potential this model could be adjusted upwards depending on the convergence, like you said, like the narrowing of these upper and lower bounds over time, and just you kind of assessing that. But the other interesting thing is the quantile regression. We've talked about how that model could potentially be adjusted down. Now the thing about the quantile regression is, if you look at kind of the pattern right now, is last cycle was unique, right? So last cycle was interesting because it was the first cycle we had like a distribution peak. If you look at the peak, and I mean, we don't have a ton of samples, right? Because we really only have 2013 and 2017 and then 2021. But if you look at the pattern on the 2013 and the 2017 peaks, those were parabolic blow-off tops. Those, we didn't spend as much time at the peaks. Those were like short-lived blow-off parabolic tops. The 2021 peak, the first peak, I mean, that was a distribution peak. That was actually a Wyckoff. Some people said, it was a Wyckoff distribution. We spent more time at those higher levels. So it was actually, we didn't get as high, but we spent a lot more time there. And I actually expect that pattern is more likely. Now, we don't know for sure, but I mean, I'd be interested to get your guys' perspective on that. That's another topic maybe for another stream. But you can see, because we had less, look at the pattern, like we had less the order books were a lot thinner back then, and it was just, I don't know, we have to assess kind of the different reasons, but to me it seems like it was a less mature market, and in order for big players to take profits and get out, they kind of have to bait in new liquidity, and that's why you get these Wyckoff distributions where the price kind of chops, and it keeps like faking people out thinking it's going to go higher, and that gives the big players a chance to sell and get out of their positions, right? Because if the price is only there for 2 seconds, it's hard for big players to get out. So there's these patterns that can happen, right? And that's really, if you look at the pattern, I mean, people discuss this, but those patterns at the peaks were kind of like Wyckoff distributions, and we even had a double peak, so it gave like 2 exit points for the smart money, right? Because everyone thought we were going higher. So, anyways, it's just an interesting observation. We didn't quite get up to the top band, but we spent more time there, and so potentially, if we have a blow-off top, now the question is, do we have a blow-off top or a distribution peak? So it's really, there's different factors, but you could almost adjust the bands potentially down. But if we would have had a blow-off top last cycle, we probably would have got to that top band, right? That's the difference. Like if we would have just went straight up in one sharp peak, we probably would have got to the top of the band. It was at about 95,000, right? So if we only had one peak last cycle instead of 2, and it was a blow-off top and not a distribution, we probably would have reached the same point as the previous peaks, is my guess. But we can move on.
Fantastic point. I had never thought about it, that even though the magnitude was lower than the model suggests, we probably spend more time in there, so making up for the lack of explosive price
Yeah,
action.
if you
Very
factor in both like duration and how would you say that's like
It's kind of the area under the curve, right? If you just look at that very top quantile band that you have there, Plan C, it's almost. I'd like to analyze the area in within that curve, and I think you're exactly right. Yeah,
well, yeah, if you factor in duration plus amplitude, or what, I don't know what the definition like if you like because you times them, right? It's not just like how high you go. So that'd be amplitude, I think would be the word, but amplitude plus duration, it's probably the equivalent peak, right? It's just you spent
exactly.
more time. You had a if you times it together, it's more of a duration and less of an amplitude, right? Anyways, we can move on to the next thing.
No, we don't have anything else. Just as you were explaining, I switched to your chart. But
Oh, okay. I guess we're on
is
the
there
chart
anything
now.
else you want to cover here?
Not really. I mean, this is well, I really briefly like this. We've covered this every single week pretty much, and this is just every week I've kind of like designed the model, upgraded the model as far as the design, but it's the same model, so there's no change really in the actual model. It's just made it a little bit easier for people to read the model and stuff. So this updates like constantly. So yeah, like I mean, the price is not probably not at 67 right now. Anyways, I don't. What's the price at right now? We're at
It's pretty close. 67.1.
60, yeah, okay. So we're kind of around there. So I mean, yeah, the what I added to the model, I guess that is different than last week because I just added, I have the fair value there, which is the 50th quantile like we talked about, and then I've added in two things so you can see like what quantile we're at, and then you can see the how much are we under overvalued as a percentage, right? So and like the quantile, right? So that people don't get confused, the quantile is 49.2. So we're 0.8 quantile below fair value, but we're as a percentage, we're a higher percentage below. So it was 1 point. Those aren't supposed to add up to 50, right? You're not supposed to undervalued. When you take that percent, you combine it with the quantile, you're not going to get to 50 because it's one's a percent and one's a quantile, so they're different. But basically, the model shows we're just undervalued a couple percent. We were a few percent over, basically yesterday. So we're kind of hovering a few percent over and under the fair value, right? That's where we're kind of hovering right now. But yeah, as you can see, this is similar to what Sina was showing earlier. This is only based on today. So the model he showed earlier was projecting out to the end of next year. That's why the numbers are higher. This is as of today. So in the model today, if we were to get up to the 90th quantile, like the first kind of danger zone, that's 145 on this model. But this is all based on today. And then the bottom, these numbers go up every day, like we talked about. The thing that's I guess interesting for people that think there could be like a black swan, we've discussed this previous weeks. That's kind of the bottom range of risk. So the risk you could say right now is to draw. I mean, again, the risk is you could go lower. You can always go lower. Right? This is again probabilities, but we're pretty confident that the parallel support is pretty solid. So 34K is kind of like the lower range of risk. Don't leverage up or do anything stupid. It's not financial advice, but that is kind of how we look at the downside risk. And then of course there's more upside potential, right? So we're at, what are we at? 66, 67. So 34 is kind of the downside. And then if things play out like we expect, anywhere between 150 to probably 300 is kind of the upper bounds, I guess you could say. If we peak, maybe because we could peak in 2026. That's another possibility. So, but anyways, that's basically with this model. It's just kind of an update showing people.
Perfect. So my takeaway is the upside is 4 times, like if you look at this chart, this is 4 times higher than the downside. So very interesting, actionable, useful thing to realize. We are way below the maximum potential of this cycle. And I think all three of us all three of our analysis are kind of pointing towards the same thing with slight differences, that we are in a great place in this cycle. It's not as great as when we had the biggest, the most undervaluation, but even after all these recent pumps, we aren't overvalued. And if you're thinking about allocating, it's not a bad place. Not financial advice, but if the past cycle patterns repeat, we are still in a wonderful place, and we still haven't seen anything that this cycle has to offer. And all the kind of bubblish behavior that the ETFs caused in quarter one of this year is deflated and has been wiped out. So we're just forming the new base for the next run up.
Yeah, it's interesting because we got up to 66 on the Quantile, and then we dropped down to like 45 or something, right, or even less. But now we're at around 50. But yeah, it's interesting how if you go back to the last one quick, yeah, right there, you showed it really well. It looks like we dropped down even to almost 33. But could you mind going back actually one more time really quickly, Sina? Sorry, the one you were just at. What did we actually got back to 33? That's interesting. We hit 66 and then we actually dropped back and actually found support at 33, it looks like.
Yeah, that's what I'm saying. This is very surprising to me that these 33rd and 66 regions match so well with important price actions. Like you see these ones, we got very close. We don't have a perfect hit on every point, but if you go back in the data, these seem to really be meaningful points. Like here, you would probably see it better in this point that 66 and 33 really it feels like to me that this is a completely different region, different behavior. And I like to call it a warm-up zone. We are just boiling the water, and once it reaches the boiling point, it's gonna just explode up.
Yeah, like once we break through 66 on the Quantile, like I would be surprised if we go back below it. Like once we break it, we're probably gonna, at that point, things are gonna start just to probably move up to wherever we're gonna get to at that point. That's the most likely thing I would think. But and then sorry, Sina, do you mind going back to the one last time to the other chart? So like as a visual, right? So the gray dashed line on the chart there, that's the fair value line, right? And so you can see how much closer it is to the bottom, just as a visual. Like I like having on the chart because you already kind of showed that with the red lines there, but it really shows you that the fair value line is a lot closer to that bottom line, right? And so even though we are at fair value, like you already said, there is still more risk to reward even at these levels, even though, ideally we want to accumulate in that bottom third below 33 Quantile. Even at 50, we're still, everyone has to decide what they want to do, but it's still not a bad place to be, purchasing now, DCAing or whatever, right? But the thing is, also at the end of next year, kind of the downside is 55, right? So we're already at 67 right now. So I mean, if you buy now and you basically hold, say you hold through the whole peak and then to the next cycle, there's no guarantee we'll get down to the very bottom Quantile 1%. Like it doesn't mean we have to get down there. In fact, we didn't really get down there, like I've pointed out before, like not last cycle, or sorry, not last bear market, the bear market before, we didn't get down to the blue band. We only got there during COVID. So yeah, I mean, you could say that there is a possibility that actually, you know what, I have to correct myself, because most likely if the 4-year cycle continues, we're not going to get down to the blue band at the end of next year. Probably that blue band we wouldn't get to until 2026, right? Probably until actually towards the end of, usually takes a year to go from the peaks, at least historically speaking. It's actually been pretty consistent that it's taken about a year to go from the peak all the way down to the full capitulation at the bear market lows, right? And so that would actually put us closer to the end of 2026 if the cycle continues the way it's played out. And so that bottom blue band is actually going to be probably about where, I don't know exactly, but I think it's closer to 70K. Do you guys know what I'm talking about? Oh, do you guys still there?
Yes. Sorry.
Oh, you are. He disappeared on the
I'm
screen.
handling the comments.
I wasn't sure.
Yeah, I love that comment that just popped up. That
that's great. No, you got it. But you guys know what I'm speaking about, right? Because I actually I was thinking about, like, because that 55 number, that's only the end of this year, right? So that's if we bottomed out and capitulated to the low at the end of this year at 55, which we're not going to. That's not really going to happen, right? Because that means we'd have to be peaking like Q1 or Q2 of this year, and then having a violent, capitulation down to the lows and have the bottom of the bear market be at the end of next year, which is not likely to play out, right? So most likely, I mean, if you look at every single cycle, it's taken a full year. It's kind of incredible how it's played out, because we peak and then it's like a full year where there's still like to drain all the hope out of the cycle. It just takes a full year to grind down, and then eventually you have this capitulation at the bottom, and it takes a year roughly to play out. And so, I mean, I think the prices of that blue band are closer to 65 to 70K. So really, if you're buying now, even if you hold, assuming this pattern continues and this model holds, even if you bought now and just held for the entire time, worst case scenario, like like chances are this is going to be your price point. And it kind of makes sense. We've spent a lot of time here also building support for the last 8 months. So I really do think this last 8 months, all we've been doing is just reinforcing the floor of the next cycle. And that's if we get down to that floor. We don't know. Maybe things like we don't have the same level of capitulation bear market. Maybe because we have bigger buyers now, we have institutions, all this stuff, ETF. Maybe we don't even go under 100,000.
Yeah, that's exactly what I was just gonna say.
We don't know, right? We're assuming kind of like we get back to that blue band. There's no rule that says, there's no law of gravity that says we have to go back to the blue band. That's just the distribution potential. That's, maybe it takes that extreme black swan to get there and we don't get that. And so maybe, 100K holds but the point of saying it is, I guess now that I'm just kind of thinking out loud here. Yeah, I really do think, like I've already said, I'm repeating myself now, but like it's hard not to think that this 8 months of sideways has not been like reinforcing a very strong floor. Like, what are the chances that we go up to say like 150 to 250K and then we crash all the way back down and then go below this floor we've put here? Like, it's just, I don't see that happening. Like, I don't think we ever go. That's why I think once we break 80K, we'll never go below, never say never, but I think the chances are really low we ever see below 60K again. That's my take.
Yeah, like going back to even 75, 80K would be even quite low. I agree. I mean, it's totally possible we just settle back down to, once the bubble, the air is being let out of the bubble, we settle back out at like 100K, like you said. So, and I was kind of noticing that yesterday, looking closer at where we might be going with the top. So I agree. Yep.
I love the new ways you guys always find to look at the data. Like, I never thought about it this way. Like, the price today, if you're buying today at this price, you're buying at next year's bottom. So what's the worst thing that can happen, right? So it's very reassuring.
Yeah, fair value today is basically the 0.1 to 5 quantile in the end of 2026. So that they're kind of like equivalent on this model.
Awesome. On that sanguine positive note, keep on stacking, guys. And this is, I think, all the charts that we wanted to cover. I hope our analysis makes you more convicted and gives you a better idea of where we are in the cycle. It's really hard to understand if we are overvalued or undervalued if you don't have a well-tested model or rule, or if you don't have just a lot of experience to compare the psychology based on what you hear around you. But this is one guide and one tool you can use. And again, in our show, we will keep monitoring everything. We will discuss. I think we've built something amazing in terms of even beyond this show. We have, like, this year, a lot of the interesting analysts that I've been following, they got together and they talk a lot. So there's a really good chance that we will catch problems, issues, or interesting pattern changes, and we will continue to refine these models. So with that, and I know
I should announce one other thing. Like, so just sorry, Sina. Keep an eye out for people watching. First of all, we appreciate you guys tuning in and sticking around to listen. Sometimes we do kind of get into the weeds of things and tend to stick on a topic, but that's just kind of like who we are as analysts. Like, we really go kind of deep into these topics. So to really understand what's happening here, right? You can look at 100 models, or you can look at 5 models in extreme detail, right? What do you get more value out of? If you look at 100 models, you just get confused, or 100 metrics or 100 indicators, right? So but I am posting just for people to keep an eye out, and I would definitely appreciate it if you guys are able to repost it. I am going to be putting out today basically a top 50 analyst thread. Now, yeah, basically it's top 50 analysts. Like I've been on X for the last 4 years, looking at other people's charts, talking to so many analysts in the space. Like I've made relationships and talked to so many different people. I've observed the work of so many different analysts, and this isn't as unbiased I can possibly be. This list, I put a couple people on there, to be completely honest, that I've had. I haven't gone along with at times, but I just put them on there because they deserve to be on the list. So I think it's a really good list, and it's not perfect. There's a couple people I'm sure I left off and whatnot, but I think it's a really solid list of 50 of the best analysts on X and in the space. And so, yeah, if you guys are looking for more people to follow, it's definitely worth checking out, and appreciate if you repost it as well. And I'll be posting that as soon as I can here in the hopefully next few hours. So, but yeah, that's basically it.
Awesome. So everyone keep an eye on that one, on Plan C's post. It's going to be something you absolutely want to bookmark and come back to several times. We have almost 3,000 people watching live across all the channels we're streaming to. Thanks a lot, everyone, for joining. Your support and your positive energy is what gives us energy to continue this show and constantly improve our work. With that, I appreciate your attention, and we will see you next week.
Thank you, comrades. Thanks, everybody else.
Thanks, guys. Have a great week. We'll see you next week.